So Bill Ackman, a couple of months back, said that he could see U.S. Treasury yields, especially the 10-year yield, hit 5%. And since then, he's been kind of right. And we haven't hit 5%, but we've been seeing bond yields on the long end move up higher. Now, what's going on? Why is that? Why are we seeing the long end bond yields move up higher? And it all has to do with what the projections were during the FOMC meeting, the last FOMC meeting, where Powell came out and said, hey, we expect less rate cuts next year. We expect rates are going to be higher for longer. And because inflation is expected to be sticky for quite some time. So if inflation is expected to be sticky for quite some time, that would make bond yields, especially on the long end, move up or stay higher for some time. Now, the 5% level takes us in the 10-year all the way to May 2007. And we're not far from it, and it can happen. But there are a couple of things that is needed before we get there. And those things are, most importantly, the beginning of October, we're going to have to see how the jobs numbers come out. The non-farm payrolls report, the ISM numbers, and most importantly, inflation numbers. If the jobs number, ISM, growth data, jobs data continue to be resilient, show some strength, that's not a good thing for bonds. That will cause the yields to move up because you're basically saying that the economy can handle whatever has happened so far with all the rate hikes. Even if the Federal Reserve doesn't hike rates, the bond prices could continue to sell off, causing the yields to go up and creating tightening conditions in the economy. Because those long duration yields, especially the 30-year, is linked to what? What product? The 30-year mortgage, right? That a lot of people have. So you can expect mortgage rates to go up if the data continues to be resilient and strong, because guess what? The bond market will start to say that, hey, inflation may stick around for some time and rates may stay higher. And in fact, if data continues to be hotter or if inflation picks back up, then those 2 rate cuts that are penciled in for next year, maybe 0 rate cuts for next year. Maybe we might start talking about rate hikes again. That will also bring another rate hike for this year. The probabilities of that could also go up as well. And again, the bond market will reprice that. They will continue to reprice it depending on how the data, the labor market, the growth continues to be. Now, what about the inflation side of things, right? I thought inflation's been coming down. It has been coming down, totally right. But can we see a spike back up in inflation? And this is what Powell and many of the Federal Reserves are worried about, that although, yes, we're seeing inflation come down, but it doesn't mean that inflation can't spike up again. Just look at crude oil. Crude oil went from $60 to $95 a barrel. If crude oil continues to go up higher and higher, that's going to seep into the inflation CPI report. Now, Powell did say that he sees through the oil prices because oil prices are very volatile, and he's looking more in depth in inflation and the other areas of inflation to see if there's stickiness. And according to that, we'll make a judgment based on how those other factors or other numbers look like. So what are those numbers? Those could be wages, shelter, food prices, which happen to be also all up and sticky as well, right? Hike the rates, that feeds into higher mortgage costs, higher rent, higher shelter prices. Although he did also say that he's looking at the super core number of inflation, which basically means taking out shelter out of the core number and looking at how inflation's playing out there. But that doesn't mean that they're going to start cutting rates. They do acknowledge and understand that there are other areas of the market where you could see prices go up, and especially oil, even though he did say that he sees through them. If oil continues to go up $100 a barrel, 110, 120, 130, I don't think he's going to ignore those price movements. And guess what? When the consumer goes to the gas pump and sees higher oil prices, it's also going to have an effect on the consumers. And there's many things that crude oil goes into for this economy, for it to run, right? And that could trickle into other areas of products, services, so on, shipping, transportation. That could all see prices move up. That just makes inflation stickier, thus causing bond yields to stay up higher or even hit that 5% target like Bill Ackman's been saying. So could we see that 5% target? I think it's possible. All depends. Let's take a look at how the data comes out this month in October. Continue to also watch the yield curve. The yield curve continues to steepen at levels back when the regional banking crisis happened. You're seeing the yield curve start to spike up. And that's because the short end of the bond curve, the yields are not moving, but the long end is moving up higher, which is causing the yield curve to go from inverted to flattening to now moving into steepening mode. Now, it's still inverted, the yield curve is still inverted, but you're getting a steepening trade here, and if this continues to be the theme, you will see the yield curve continue to steepen further and further and further. And if that's the case and bond yields continue to move up higher and higher, we don't know what else that will bring into the economy in terms of stress and pain, right? We've already seen the stress and pain of higher bond yields on the regional banks, in the UK for the UK pension funds. If we're going to see higher yields, doesn't that mean those same sectors that were affected might get affected again? The banking sector might get affected again. Maybe some pension funds might get affected again. Some traders might get affected again. Might cause yields to basically affect their balance sheet, their business, especially if they're leveraged a lot. Don't you think if we had a problem back then in March of this year, it might arise again, especially if the yields go to 5% or higher? We're talking about yields that are higher than what we've seen in March of this year. So, I mean, you can put the dots together and see where I'm going with this. If this continues and the bond yields continue, this will put more strain in the economy, more stress in the economy. And there might be some players, aka commercial real estate, the banking sector, or what have you, or pension funds, shadow banking, that could feel the pain of higher yields. And then maybe, just maybe, once that happens, it may bring a collapse to some area in the economy that could cause some panic selling. And then maybe that's the trigger point that causes inflation to finally come down to the 2% target. Anyways, these are just my thoughts. Leave a comment below. Let me know what you guys think. And let me know if you see yields hitting 5% and what that may do in the country that you're living in, the economy, and so on. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.